All right, hi guys. Let's get going. My name is Paul Lange, and I'm going to do a little talk today about long-term trading, investing of stocks specifically. Here is the bullet point list that you probably saw that I want to make sure I do cover because I promised you to cover these things. I'm going to go over a whole lot more, including a couple of charts. Everybody likes to see charts, right, of wonderful plays. So I will show you a couple of those as we go along too. I want to make sure we talk about, to me at least, it's not acceptable to not take action in a bear market. I'll talk about why in just a minute. Tops and bottoms are relatively easy to spot most of the time despite popular belief. While long versus short is technically identical, there's an important aspect that is handled differently. It's critical to know this. Why swing trading will kill your account for most of you. I'd love to hear your feedback on that when I get there. And the big edge you have when you are trading stocks, make sure that you use it. Remember, to take no action is an action. Paul Lange, you may have maybe heard of me, or you know me back from Paul at Pristine. Pristine was a company that I was with a long time. I went off and started my own place called Disciplined Trading Strategies about 18 months ago. It has been a riot. I'm just having fun. I do a trading room. I like to do two things. I am a day trader and a long-term trader. I have a trading room that I'm with my group every day, and I also have a long-term trader advisor letter, if you want to call it that. And I also teach, so kind of an all-in-one stop shop. I love doing it. I enjoy doing it. I enjoy doing it, and I have a lot of fun doing it. I personally like to trade stocks and futures. Now, I teach technical analysis. I am 110% a technical trader. If you don't believe that, either I'd like to teach you something or we're not going to get along because I've been doing this a long time. I didn't necessarily get told that. I proved it to myself. I think one of the problems with technical analysis is a lot of people don't really understand it. They get a sampling of it on quick little slides on an internet or a free presentation. It doesn't work for them, and they think that's not it. Technical analysis absolutely positively works. It is the only way for 99.99% of the people to make money in the market. I don't really care whether you like to do futures, stocks, forex, commodities. It works on all of the above. It's all great. I think there is a certain advantage you get trading stocks. I'm going to show you that on a slide in just a minute. Stocks give you an edge. What to trade? If there's on my website, there is a page called Free Stuff. And if you go there, you will see a lot of good free information. You don't have to be a member. You don't have to be anything. You can just go there. Here's the link to it. So that if you get bored listening to me, you can hop over there and take a look at it. You should have just got a link there. And once you're there, you can also see the home page. There's all kinds of great information there. There's a video under the newbie section, what to trade, that talks about trading and what you should trade and the advantages and disadvantages of each one. I like to day trade. I like long-term investing. I don't care what you call it, whether it's long-term trading. I use the word trading kind of universally for everything. I don't know if you guys do or not, but the terms don't matter. It's just semantics. You can call long-term trading investing if you want, just so we understand these next two bullet points are really important. It's not about buy and hold. That concept is long gone. We are in a different environment than we were many years ago. And it is not about fundamentals. Fundamentals have nothing to do with making money at all, period. If you want a lot of good discussion about that topic, I do a class. It's actually the first part of the class for the people that pay for classes. But I open it up to everybody the first half day. And the next one is going to be Friday the 14th. And you are welcome to attend that. You do have to be a DTS member to attend that, but there's no cost to do that. There's no credit card. You just give me a made-up email address and you'll be invited to that event. So that's me. Let's get on and talk about what we're going to talk about here. Time frames. This chart here is a chart of the market. I use the QQQ and the SPY. This happens to be the QQQ. Tops and bottoms, one of the topics I said there, were relatively easy to find most of the time. Now, I know you can look at a chart afterwards and say that, but you have to keep in mind there's probably a lot of people here that know me, that subscribe to my stuff, and I put out both a day trading letter and a long-term letter. And this October top I actually called, meaning said in explicit terms we're about to drop, and actually took short positions 2 days before we dropped. It was on October 2nd. Down here, This actually happened right on the Christmas holiday, but coming back on January 4th, I said that is the bottom, went long, made money going long. On the way up here, this is where I want to get into the advantage you have in stocks. Hey, 199. I'm not sure what that means, Kevin. By the way, guys, again, I can see your questions, and I love back and forth banter. If you have anything to say, feel free. When you attend anything at I think I'll read the question because I don't think you guys see each other's questions. I'm not sure. If you attend anything at DTS, I have the room open. You can see other people. You can see what they type. I welcome everybody and what they have to say all the time. It's not a closed room, even for the free events. Up in here, I started shorting right through here. Boom, 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 boom. Did I lose money? I started shorting early. Full admission here. I didn't start right at the top. I did nail the top. Up here, I went short. I went more positions than I've done in years at that top, and they're paying off very nicely. But on the way up, did I lose money through here? I started shorting right here. Yes, no? I started shorting here. Did I lose money? I love it because you said the wrong answer. No, I did not. Why did I not lose money? Because this is the edge that I talk about. I didn't short the market. I shorted stocks, also known as equities, that I felt had unique patterns. Now, I didn't do great. I did make money, though. I came out a little bit profitable on that run up because I got a real home run and one that made a little bit and then had some losers. But it balanced out. So it was kind of a free shot. And that's what you have doing equities. If I did the market, yeah, anytime I tried it, I would have lost, right? So by picking on stocks, and there's a certain pattern that you want to look for. When we're hitting a prior market high, there's a very specific pattern you want to look for. And it's not relative weakness. You don't want to be looking for weak stocks when the market hits a high. Anybody know why that is? I have to 2:15, so I'm going to kind of monitor my time here because I have a lot to go over. So I can't give you too much time to answer. But does anybody know why you don't short relative weakness when you're shorting a market that has been strong into a prior high? It's because if you notice, they don't drop. The weak stocks actually get bought when the other stocks sell off. It's called sector rotation. You'll see that happen. And a lot of people get confused. They say, well, here's a weak stock. The market's been railing. I'll short this. Now the market's to the top. The market drops and they lose money. How does that happen? Well, there's a certain pattern you have to look for. And if you look for it, you usually come out fairly well. I think one of the stocks I'm going to show you actually has that pattern to it. So daily chart. And then right up in here, then when we did at the top, I was actually down getting the top on the weekly chart literally with a trigger off of an hourly chart. I know it sounds kind of weird if you don't know what I'm talking about, but it was a very precise top. And May 6th and 7th, I ended up doing 4 positions short over that period of time. I like day trading, holding larger positions for hours for income. It doesn't have to be hyper at all. There are many styles. And I like long-term trading investing. It's the other extreme. It is important, I think, to be involved in both. Do you know what percentage of the market gains come overnight? Does anybody know? It's kind of a real question because I've heard a lot of different answers. I went to look it up while I was waiting here and I couldn't find an explicit answer. But a huge amount of the gains come overnight. I don't quote me because I've heard anything from 80 to 92%. A huge percentage of gains come overnight. So you need to be, as a longer term trader, you can't be afraid to hold overnight. You just have to do it the right way. But large gains come, most of the gains in the market actually come on the overnight gaps. Market gaps up, go sideways all day, and if you're not in overnight, you're stuck. So I think an overnight time frame has to be one of the things that you do if you're involved with the market. However, you notice on here I do not have the term swing trading. Swing trading is a fairly common term. Again, it probably depends how you define it. But generally, it's that person that holds 2, 3, 4, 5, 6 days, trying to get that quick pop out of the market. It's very popularized. Let me ask you guys, if you swing trade, do you do well at it? Do you do well swing trading? Do you feel rewarded? Are you happy about your gains you're making swing trading? See, I think swing trading is a very, very bad time frame. I know I'm going to catch garbage for saying that because it's been popularized so much. But it is a very difficult time. You have very difficult reward to risk concepts. You're holding overnight with the risk, but you're not getting all the reward. And also, I'm willing to bet you that most all of you who are swing trading are probably stopping out of your positions on the morning of day two, correct? Swing trading actually kind of evolved as a marketing concept a while back. Why is it a marketing concept? Well, the vast majority of people, even though you hear a lot about day trading, the vast majority of people can't day trade. They don't have the time, they're not available enough, and or they don't have the money. It used to be a long time ago you didn't need special money. Now you have to have $25,000 to day trade. So what came about was from brokers and from people who want to encourage people to get in the market was to say, hey, do this swing trading thing. You know, you're getting these fast gains. It's almost like day trading, but you're getting more money because you're holding overnight. But you know, a lot of you are not responding to me, but I got a hunch. I mean, you're agreeing with me. I've been around a while. I'm not stupid. Swing trading is a difficult time frame, so I do not encourage that. I like the two extremes. Also, if you do day trade, swing trading tends to interfere with your day trading. It's very distracting. So I like either to day trade or to hold positions for a long enough time that I really don't even care. Again, on that free stuff page, there is a video on there called Beware of These Two Time Frames that you may want to read that discusses that in more detail. All right, time frames. Everyone, if you can participate, what time frame is this? This is a chart. It's a candlestick chart. It's in an uptrend. I'll give you all that. What time frame is this? Is this a monthly chart, a weekly chart, a daily chart, a 1 minute chart, a tick chart? What is this? Right. Absolutely. It could be any. We don't know what chart it is. It could be any chart at all. And that's an important concept to understand. See, none of the technical concepts change actually, whatever time frame that you're on. It doesn't matter what this is. When you learn technical analysis, this is what we're looking at. This could be a monthly chart of something that's covering a period of 7 or 8 years. This could be a weekly chart of something over 2 years. This could be a 1 minute chart of something. This actually happens to be the 5 minute chart of Roku yesterday. ROKU. It was a play that I took. Let me ask you something about this. Right here, can you see where I'm pointing? If you entered right there, what would have been the outcome of that trade? Would you have made a lot of money or would you have stopped out? If you entered right on this bar here, if you entered on that bar right there, would you have made a lot of money or stopped out? Right. If you went long, you'd make money. My point was I wanted you to see is that you notice that right here, a lot of people would have stopped this out. A lot of people would have stopped this out. There is no way that should ever happen to you. There's ways you could avoid this. While stops are absolutely necessary things, the way most people use stops costs them money. You understand what I'm saying? The way most people use stops, it costs you money. And I've talked to so many groups, I don't have to ask you. I know most of you agree with that. If you look back, you find out, like for example on this day, if you set your stop and left for the day, you'd come back and at first your heart would skip beating because you think you made a whole week's salary, and then you find out you weren't in the trade, you lost money. That never, ever, ever should happen to you. There's ways to avoid that. Not the point of today's discussion, but it just happened to be a feature of that chart that I wanted to show you. Technical analysis, any time frame, long or short, doesn't matter. But there is, while technically speaking, there is no technical difference between long and short. All the concepts, strategies are the same, except flipped. There is a difference between being long and short, and it's important when you talk about the long-term time frame. What's the difference between long and short? Is there any difference in the way things, this is one of the bullet points I had, is there anything difference in the way things are handled practically? Is there any difference in the way things are handled practically? The difference is things drop faster than they rally. Things drop faster than they rally. It's not uncommon at all to have one bar erasing 5 or 6 bars of move up. One bearish bar erases 5 or 6 bullish bars. One bearish week erases 4 bearish months. That happens all the time. And it means that if you are going to be an astute trader and also playing short when appropriate, you can't miss entries. You often don't get a second chance. Does that make sense? So you just have to be a little more fine-tuned because while the strategies are the same, you don't get that second swing if you miss it many times. I want to talk now and focus on the long-term concepts a little bit. Again, holding for a long period of time. Why is this such a big topic today? Well, the reason it's a big topic is because we are in a really unique time right now, right? We have been for a while. You guys remember, I mean, there are people that used to get 15, 16% return going to their bank buying CDs. Anybody of you get returns like that in the past? Some of you, if you're fairly young, you probably think I'm lying to you, but right? Anybody out there get returns of 15, 16%? Back in the 80s, that's what returns were. So for a lot of people, it was not. Some people saying yes. So back then, perhaps the need to understand the stock market for the average person. I know there's always people that maybe, well, back then, of course, it wasn't even day trading around, but there are people today that maybe don't care about day trading, but they want to do something with their long-term money. Obviously, there's a lot more people interested in their long-term money because not everybody can or does day trade. But for long-term money, it used to be the fact that it wasn't a big deal. I mean, hey, go get a CD, 15%, that takes care of it. You know, saving for your retirement over 20 years, it's fantastic. Can you do that today? No. I mean, interest rates are basically zero, right? The bank is a convenience. It doesn't make you money at all. Um, gold will never return to its prior highs. Never, ever. Despite what all your favorite movie actors say and everything else. I've talked about that in other presentations. It's not the subject for today. We can talk about it a week from Friday if you come to that event. But gold is not the place that's going to make you money, even if the market crashes. It's done. And by the way, I'm not saying that out of ignorance. I am an old gold buff, if you will. I understand the whole concept of store of money. I understand the whole bank crisis. I understand all that stuff. And I'm here to tell you that it's a thing of the past. We are in a new concept, a new economy, and there is no such thing as gold being the store of money anymore. It's gone. It's tulips. Mutual funds. Anybody know what percentage of mutual funds beat the market? About 7%. 93% chance you put your money in a mutual fund, you will not even beat the market. Mutual funds are designed to try to keep up with the market, and the market may not even be the right place to be. Hey, Mary. She's laughing at, Mary's laughing at my "it's tulips" comment. So mutual funds is not the answer anyhow. In other words, if you simply want to be in the market, if that's what you want to do, I'm not saying it's the right or wrong thing to do at any moment right now, but if you want it right now, you feel it's time to go long the market, you can go out and just simply buy the SPY for free. Go to your bank and they'll open an account for you. They'll give you 10 free trades. Buy the SPY. You're long the market. You know what you just did? You just beat 93% of the mutual funds. So that's not the place to be either. It makes no sense. And there's a quick little blurb from that article basically saying that, blah, 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 over the last 15 years, 92% of large cap funds lagged, 95% of smaller cap funds, mid cap funds, 93% lagged the market. So that's not your answer anyhow. What is your answer? Well, one of the answers can be is to take charge of your own money, and this is what long-term trading investing is about. Now, when I've done this before, I never used to talk about this concept of financial planner. Somebody emailed me one time, and as I was kind of poking fun at some people in the industry, including mutual funds, somebody said to me, does that mean we should take your comments to mean that financial planners are bad things also? My answer is no. Financial planners can be great things. I would highly recommend the right financial planner. Understand what that is. Now, so that I was sure I knew what I was saying, I tried to look up what a financial planner is, and it's so confusing, I'm not sure I even want to try and explain what it is. But just a common sense English word, don't hold me to the definitions of a planner versus other terms that they use. But basically, a financial planner, I'm talking about somebody who's going to take a look at you and your total picture. How old are you? How much money do you have? How aggressive do you want to be? When do you want to retire? How much money do you want to retire? And they're going to say, okay, you know what? Here's what I think we should do. Blah, blah. You should take your money and, pay off your credit cards first, pay off your house then, put some money away into bonds, blah, 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 blah. And then you're going to get to this point where you say, okay, and then here's a pile of aggressive money. In other words, they're going to try and figure a plan for you where you could kind of retire minimally, above the poverty level, if you will, even if nothing else worked out, just by putting some fixed assets to work for you. But then there's going to be a pile of money that they're going to say, okay, this is your aggressive money. What do you want to do with that? And this is where you got to be careful. You want to make sure that if you do go to a financial planner, you go to one that you pay him or her to help you. Do not go to a financial planner that helps you for free and then has you put your money into their products that they get commissions on. That's not what you want at all. That's the worst thing you could do. But the only difference with a financial planner is when it gets to that point where they say, okay, you know what, here's some money, let's talk about what to do with it. Let's be more aggressive. Let's talk about, maybe some stocks or something like that. Well, the financial planner's idea of stocks is going to be different than what it really should be. They're going to tell you that stocks are very risky because the market can crash and you can lose all your money and this and that. And this is where you got to take what a financial planner says with a grain of salt. A financial planner, in a sense, is exactly in competition with the stock market. Does that make sense to you at all? In other words, we have a couple of financial planners in the area where I live that advertise on the radio all the time, and they sound like great guys. And like I said, I like financial planners, don't get me wrong. But for them to get more business, they have to kind of slam the stock market, right? They have to say, boy, if you're still in the market, you're an idiot because it's going to crash, blah, blah, blah. Well, they're getting close to being right, but you know what? They started saying this 7 years ago. For 7 years. Anybody else hear the same thing? Give me a yes. For 7 years, there have been people telling you the market's going to crash, right? You would have missed a 300% gain in the stock market by being too cautious. I have been 100% bullish in the long-term picture, unwavering, flat-out bullish. And by the way, I am a bearish person by nature, just so you understand me. It's hard for me to be bullish. I've been a 100% bullish person for 10 years, even though I have a bearish nature about me. So for me to say that, it takes a lot. But you never ever go into the market and just say, hey, here's my $50,000. I'm going to buy the market now. And then what happens sometimes when people do that? Well, then they start losing. And then they say, well, I think was it IBD? Investors that has this great rule that everybody loves. Oh, well, you have a 7% stop loss. That's the stupidest thing I've ever heard of. If you're doing that using a 7% stop loss, then stop doing what you're doing and just put all your money into bonds and just forget about it. You never ever do that. You leg into positions, and you should never ever be in a situation where you're losing 7%. You should never be in that situation, period. Okay? You have to learn how to properly handle long-term investing, how you get into things. Now, obviously, there's a couple ways to do it. You can learn how to do this, but I also understand that not everybody wants to learn how to do it. Maybe you're busy making your own money. Maybe you're busy and you don't want to learn. If you want to learn how to do it, that's one of the things that I do. But today, it's kind of more about, well, hey, if you don't have time to learn, what are your choices? Well, you have a couple of choices. You can do it yourself, just, winging it, if you will, or getting whatever education you can free. And if you're doing well doing that, I say congratulations. Some people can kind of make it long term. It's a lot easier than day trading because there aren't emotions involved. And by the way, we're getting to a couple charts, so don't worry. So you can try it yourself, and all I ask you is just a common sense analysis. There's nothing wrong. If you can do it yourself, that's great. If you can go out and pick your stocks, time the market right, and do all that. But all I ask you is, how is it going for you? Are you making money or are you losing money? And just be real, honest, and objective about it, right? If you're making money, you have the best of all worlds. But most people, if you ask them, they are not doing that well, and they're frustrated. And worse than that, they're constantly tense because they're trying to figure out an endeavor that they really are not skilled at. Does that make sense? Maybe that describes some of you. I don't know. The other concept would be then to subscribe to a managed letter where somebody says to you, hey, here's what you do. Go long, here's your stocks, go long, here's how we're going to manage them, and just mimic what I'm doing and make your money that way, where you would be actually, I'm not saying to invest in a mutual fund, I'm saying you would invest your own stocks in your own account, but you'd be doing it on the vice of a letter. Does it make sense for you to do that? Well, it's just a simple math question. All it comes down to. Just do the math. What's your account size? What did you make last year? What does the letter cost? So if, for example, this is an example, if you're looking at a letter you think is going to make at least 10% annually for you and you made zero the prior year, well, if you had a $30,000 account, it means you could be making $3,000 instead of zero. You pay $1,500, let's say, for the letter for the year, you'd be ahead $1,500. If you had a $60,000 account, you could make $6,000 instead of zero, pay $15, you're at $4,500, et cetera, et cetera, et cetera. But I also know there's a certain level of pride and stubbornness that most people just don't want to pay for advice. They'd rather keep losing time after time, and some people will never change that attitude. Let's take a look at both options. Let me give you some tips about doing it for yourself, and then also give you an idea for if you want to pay for a subscribed letter. Do it yourself, pay for a managed letter. Do it yourself. The U.S. market, you build into positions so you're never at a big risk. Now, it's harder for me to describe exactly what that means in just the short time I have, but it means basically that you hit key areas, you take individual equity trades, and you don't pile into too much at once. And then you continue to add as those positions either have their stops lowered or as you start to peel some targets off. Now, when I look at long-term positions, I have a very structured way that I do it. I usually look at taking a third of the position off the table fairly aggressively. In most cases, again, when we're talking long-term trade, I'm talking about holding for weeks to months, to even possibly years in some cases. I'm talking about taking maybe something off when I get to a level that may take 2 or 3 weeks to get there. And looking at taking a couple or 3 risk units, meaning 2 or 3 times what you initially risked. And then the second target, I'm looking for a really healthy target on the chart. And then what happens to the third target, those back thirds, they don't have targets. You just kind of hold them. And this is how you build into a portfolio. Now, if you're shorting, like what's going on right now, you probably aren't looking to hold that forever. You want to make sure you catch the whole move going down, because a lot of people, the problem is that when they do properly get some short positions going, they get out way too soon. The market keeps falling for 6 months and they're without anything. So you do want to keep those back thirds for the full run. And when we flip around and look to be long again at some time in the future, yes, I'm midterm short bias right now. Maybe I should back up and explain that. There are 3 time frames I'm always talking about. There's a day trading time frame which flips back and forth every day. There's a midterm time frame, which I am currently very, very short right now. That's saying off the daily, weekly chart, looking ahead the next few weeks. And then there's the big, big picture. That's the one I'm still bullish on. That's saying on the monthly chart, looking out months from now, are we going to be higher or lower? So the midterm picture I'm very bearish on. At some point when that flips to being bullish again, then perhaps you start to look to hold those thirds as longer term positions, and they build up over time. And that's how you build into a portfolio. I just gave you all the answers. You also use technical analysis, period. There is no discussion about that. If you are thinking that fundamentals or reading research reports or earnings reports gives you any advantage at all, you are just, I'm sorry, I don't mince my words, you're just completely wrong. You will sometimes be proven right and you think you're doing the right thing because we're in a bullish environment. You take a bullish stock, you read a bullish article, you say, well, I'm going long because of this article, you turn out to be right. Trust me, you're not. News has nothing to do with this. Earnings has no, fundamentals in general have nothing to do with it. It's following a chart. And it's not that charts, it's not that other things are wrong necessarily, it's that the chart encompasses all of that into it. And it really does 100%. You have to really understand charts to understand how much I mean what I'm saying. It's all about the entry then. The entry is everything. Most people who go to take their trades and investments use terrible, terrible entries. They wait for so much confirmation that it's practically time to be on the other side of the trade at the point they enter. You can't do that. You have to know the chart well enough to say, okay, we're going to start dropping. It's time to get in on the first sign of weakness. When you do this, when you're building your own portfolio, some positions are market timed. In other words, what I just did back in the beginning of May was largely based on market timing. I felt the market was going to drop. I had the indications I needed based on a whole lot of things. I waited for my trigger and then I found the appropriate stocks. Why the appropriate stocks? Well, in case I was wrong, maybe my stocks make money. If I'm right, maybe my stocks drop more than the market does, right? That's that little edge that you have. Some positions, however, can be unique. Some stocks you find are just like on their own page. They may not be following the market, or they could have a special situation where you can just play them uniquely. I have a couple of those right now I'm looking at doing to add to the portfolio, which right now is all short based on the market as of May 1st. Positions can be handled before or after market hours for the most part. Again, when you're long-term trading, you don't want to be tied down during the day. You're not. These are longer-term positions. And you can basically handle everything, but there may be times you want to have a focus. If you're following an advisory letter, most all the plays come out before or after market open or close. But there are times where it may make sense that you have access to the market. If you do, in today's environment with technology and cell phones, you should have access to your broker, to a market, to, if you need 5 minutes a day to update something. I think it makes sense at times. Because there's times you come into critical areas. Here's an example. I'm going to show you a couple of charts here of examples of things I did. This was a short on IBM that was done on May 6th, I think it was. We'll take a look in a second. It doesn't have the date on there. That is a cut and paste picture from the long-term trader letter that I put out. And again, there were 5 things that I did in a fairly short period of time. This is IBM. And I want to take and show you these charts because they're just some beautiful, beautiful charts. My heart skips beating a little bit when I look at some of these charts. So this is a cut and paste from the letter that went out the day that went out that morning. And this was actually, and I'm going to show you what you're going to see here are 4 charts all plastered next to each other. And since it could be confusing, I'm showing them to you one at a time, sort of. This is the monthly chart of IBM. The monthly chart is a key chart to be looking at when you're long-term trading. It's the overall bias setter. IBM is absolutely beautiful on these charts. Do you guys see where I am right here? Can you guys see it? Yes? Can you see a monthly chart, a gold arrow pointing down? This is IBM. It's hard to read it up here. Can you guys see it okay? The lines on the chart, that's a 20-period moving average, a 40-period moving average, and a 200-period moving average. They're not really critical to anything here. Okay, you can see. All right, good. This is just a beautiful monthly chart on the bearish side. When you have a chart like this, folks, I don't care what the CEO is saying about his company. I don't care what your broker is upgrading or downgrading. I don't care what the last earnings were or what they're projected to be. I don't care who's lying. I don't care who's telling the truth. I don't care about anything. I don't care what the PE ratio is. If you're looking at PE ratios, you are wasting your time in stock trading 101 Mickey Mouse class. You're wasting your time. None of that has anything to do with how stocks perform. What has to do with how stocks perform is who is buying them and who is selling them and who is winning the battle. I don't care what the reasons are. If this stock was just upgraded, if it had a low PA, I don't care what it is, this is a short because people are selling it. Month after month, the pressure is downward, and it's not accelerated to the point where people are exhausted selling it. Next chart we look at as a long-term trader is the weekly chart, right to the right here, weekly chart. This gold arrow here, now again, these charts are current, so you're seeing right through today basically, but the arrow goes back to the point in time where I shorted. Beautiful little rollover at minor resistance. Minor resistance is the most important place in the market to be when you're shorting. Minor support, the most important place to be when you're going long. It is the place to be, minor resistance. This is the weekly chart, giving me a little more detailed view of the monthly chart. Again, that little gold arrow there is pointing to approximate time of the trade, and it is also lined up with that monthly chart there. You don't learn a whole lot from the weekly chart there, but I do learn something when I go to the daily chart. This big red bar on the weekly, when you come down to the daily, you see that it was ignited by a gap. This is very, very important. This is the reason IBM was one of my very first and my favorite concepts, because this was shorted right in there. And what had happened was the stock had gapped down. And as the market continued to rally to new highs, look what IBM did. It could not get above this gap down area. Does everybody see what I'm saying here? I'm just speaking in English. I'm not trying to throw a lot of fancy technical jargon at you, but the gap down here is devastating. It is much different when a stock gaps to an area than when it trades to an area. So I wasn't trading it the day of the gap, but after the gap, it refuses to rally while the market rallies. It gives me this nice little area in here. And then, believe it or not, I'm actually getting my numbers from an hourly chart. I'm looking at hourly chart bullish pattern failures to enter short positions on the weekly chart, confirmed by the monthly chart. I know it sounds like a big mouthful of gobbledygook, but there is a very logical procedure to all of this. And the entry was picked underneath 129 is the number. What was the number? 139, basically, which ended up being right underneath that hourly pivot in there. Very aggressive entry. Triggers in, boom. So all of this gapping now, this is all happening while I'm short the stock. Boom, 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 nice drop. IBM already has a target taken, and the stop has been lowered to a spot where it's all in the money. It's a profitable trade no matter what happens in the market. That was one of the trades. I'm going to show you one other one as well. This is HBAN. It's a financial stock. It's Huntington Bank, I think, or something like that. I don't know. Short under 1374, stop 1410. The stock does not move tons, so that sounds like almost like a day trading stop, but it's not. It's a long-term stock. It just doesn't move a whole ton. Again, the monthly chart, the mother time frame here, we have a lower high on the monthly. Notice I'm not shorting weak stocks. one of those myths you've probably been told. I mean, in one concept, yes, of course, you don't want to short the super strong, but you don't want to short the super weak either in this environment. You want to short the ones that are just starting to show weakness because they're the ones that can drop the most. Does that make sense what I'm saying, everybody? You guys are a quiet group. Does that make sense? If you're shorting the weakest thing out there after the market's been rallying, the money comes to those and they have nowhere to drop. These ones that are forming the lower highs are the ones that are going to get the profit-taking selling that ignites the move down, and then real selling that propels it lower. So you have a lot of room to move on some of these. Monthly chart lower high, just what I want to see. Remember, the market's rallying to new highs during this time. Weekly chart double topped here, lower highs, lower highs. The market's going to new highs during this time, right? Daily chart, boom, right off the top of the daily chart. Right off this prior high, boom. First sign of weakness, where it actually got the trigger again off the hourly chart. An hourly trend change, a bullish hourly failure, the entry point to this weekly chart. Gives you incredible reward to risk. The reward to risk I'm using, well, I won't even go into it. This already hit a really nice target one, and again, the stop is down to an area where it will be profitable on the rest of the trade as well. And if we happen to enter a catastrophic drop, guess what? I'm all set. I got the stuff. If we end up turning around and rallying from here, these are all profitable. All profitable. Now keep in mind, when I talk about not having risk in the market overnight, a little caveat, of course, somebody could drop a nuclear bomb tomorrow. Well, of course, if that happened, my positions would be good because we drop. But I mean, if you were long overnight, I'm talking about building in a position so you're never at risk. Keep in mind, when you're overnight, I mean, there's always that chance somebody drops a nuclear bomb and the market gaps down 1,200 Dow points and you may go past your stops. I mean, that's always a risk. But I mean, other than that, you build into things so you're never in trouble. Okay? So that was HBAN. If you want somebody to give you the picks, that's one of the things that I do. It's a DTS long-term trader. I started toward the end of 18, or in the middle of 18, it was up 5%. I did very little trading long-term because it wasn't a good environment. First quarter of 2019, it's up 24%. Second quarter, it's up 40% so far, but that's mostly open positions as of last Friday. It's a little bit less return than that right now because things have rallied a little bit and I'm short. I don't want to fool you on anything. You're not putting money into a fund. You're taking your trades. You're just doing it off a fully managed letter. So the percentage return is simply calculated to say if you started with an empty account and every time I gave you a position, you put money in the account to buy that position with a 2-to-1 leverage that's available on any brokerage account in America, and you follow the letter to the T, that is the gross return you would have, not including commissions. Not that commissions would change that even 0.1% or anything. Okay. No, this is not with options. This is just actually trading the stocks at 2-to-1 leverage. Why do I include that? Well, because if you put your money into a fund, you don't get 2-to-1 leverage. You get 1-to-1. So one of the advantages you have trading stocks is you get to double your money. So you take advantage of it, right? I started my career in options. I love options, Mary. I think they're a great thing. I think they're misunderstood by some people. Keep in mind that options are not a different entity. You don't technically trade options. I know we say that, but technically you're using options to trade stocks or the market or cotton or pork bellies, or if you're Eddie Murphy, orange juice, I guess it was, right? You understand what I'm saying, Mary? In other words, you have to understand where stocks are going to trade the options on stocks. There is no such thing. There are delta neutral strategies where you're trying to minimize the effect of stock movement, but still you will always be better off knowing where the stock is going. And then options are just a way of skewing the reward to risk. Now you could look to do option strategies on these plays. I mean, you could take bull credit spreads, bull debit spreads, bearish debit spreads, bearish credit spreads. You could do anything you wanted to once you have the play. But that's just a return on the stock at 2-to-1 leverage, okay? Yeah, they do less, yeah. Well, Mary, what are you talking about doing though? And you got to be careful. I mean, I do not want you ever going out and buying out of the money calls. That's just foolish. You don't do that to mimic stocks. You either buy deep in the money calls or you do credit spreads. Or you can do debit spreads too. And when you do that, it usually takes about 1/3 of what it would take you if you bought the stock outright. Yeah. And naturally, calls and puts require virtually no capital, but they lose all the time. That's just a gamble. You could have your stock go from point A to point B, and you could lose money on the option. So you got to be careful. You just do it the right way, is all I'm saying. So there's that. There's a little plug for the DTS Long-Term Trader. If you want more information on that, let me move on because I'm out of time. Let me go through this checklist. If you want more information on that, you can go to my webpage, or if you want to specifically, here is information on that letter. For those of you who are long-term only and you don't want to learn how to do it, you don't have the time, or maybe you're just busy making your money, and you don't have time to learn how to do this stuff. That's fine. And again, just use your common sense. How are you doing now? How much money do you have? If it's not worth it to you, then forget it. But it's just an idea out there. Did I do our checklist? It's not acceptable to take no action in bear markets. I think I talked about tops and bottoms, relatively spot. Talked about that. Short, talked about it. Swing trading, kill your talk, and a big edge. Talked about all these points. I have a minute left. Does anybody have any questions for me? I would encourage you, if you at all interested in the way I talk or what I have to say, head over to the DTS free stuff page. It doesn't take any skin off your nose to go there. If you go there, you can also go to the home page and become a member at DTS. Being a member, you can just give me any email you want. You don't need a name. You don't need a credit card. And what you will do is you'll get on the list to attend free events. I do lectures like this a couple times a month. And you also get a free market summary, and you get some other benefits, and you get an occasional educational email I'll send out. So feel free to head over and become a member at DTS. There's a direct link to the member thing. And all you need is an email. It asks you for your first and last name, but you don't need to do it. Obviously, put an email address. That's where things will be sent, so make sure you have access to that email account. Anybody have any questions? Did I bore you to death so you have no questions, or I answer everything so completely thoroughly that you have no questions? Thank you, Jamie. You said, great job, Paul. All right, thanks, guys. I'll see you next time.